Well, hello, Internet, and welcome again to my live coding session where you're free to ask any questions you may have. And again, today, what we're going to be doing is continuing what we did previously, which is learning how technical analysis works and how to, 100% free on your computer, go and use data science techniques just like investment bankers do to go and analyze stocks. And today what we're going to do is I'm going to be covering Bollinger Bands, I am going to be covering moving averages, resistance, support, and I don't know, whatever else comes up. And I always get questions about cryptocurrencies and such, so I'm going to talk about those as well in this video. And of course, I'm always open to answer any questions that you may have. So let's just jump in here. Boom. All right. So what I'm going to talk about first is what exactly Bollinger Bands are. Now, whenever you plot them, you're actually going to plot three moving averages, but mainly what you have is two lines that are going to be moving averages, and they are going to have different standard deviations. And depending upon basically they are support and resistance lines. So if a stock goes above a resistance line, that means that that would be inclined to tell you that that security should be sold. And if they go below a support line, then that would be a situation in which you should buy. And historically, if you are using a stable investment like the S&P 500, then things like resistance lines and support lines are very clear indicators that if we go below a support, that it's almost always going to bounce back. Now, of course, it depends upon the security that you are working with and whether it is stable or not. S&P is pretty stable because it's the whole entire stock market. Well, it's not the whole stock market, but it's a large number of very powerful and good companies. Well, this isn't investment advice. This is me just educating you, and of course you should go further on, and I just create tons and tons of videos like this. So what I'm going to do here is I am going to start coding everything, and if at any point in time anything doesn't make sense, feel free to go and ask me questions. So what do I want to do here first? Well, as it says, I'm going to create a middle band. That's a middle moving average that's going to be based off of 20 days. And what that does is it's just an average that cuts out any major fluctuations in stock prices. That's why we use moving averages. It tries to just smooth out our data so that any short-term occurrence doesn't dramatically affect our results. And then we have our upper bands, which is just going to be our standard deviation and plus whatever the moving average is. And then we're going to have a bottom band, which is going to be the minus standard deviation. And it's just how the stock fluctuates over time. And that creates our support and resistance lines. And as we go on in this video, I'm going to talk more about other support and resistance lines that are much more definite. So let's create a function here. So I'm going to create a function, and what it's going to do is it's going to add, and what this is the previous video I uploaded here on Switch, or Twitch. I keep saying Switch like a Nintendo. We went through and created price charts, all these different analysis tools to analyze the different FANG stocks. We created numerous different functions that allow us to do countless numbers of things. Merge. Maybe it's a good idea to review what we did previously. Of course, you should watch that video. But I'm just going to briefly go over what I did in the last video, just so you're 100% aware of what's going on if you've never seen this. Okay, so we imported a whole bunch of libraries, and also all of this code is going on GitHub as soon as I'm done with this. Let me give you the link to GitHub so that you'll be able to get it. It's all 100% free because it's all on GitHub. I don't sell absolutely anything. All right, so where is it? Let's go, just verifying. Yes, so it's going to be called Technical Analysis 6, and it is going to be in this directory on GitHub. If I can look here and see what I'm doing. All right, boom, boom. Okay, so you're going to be able to go and get all these files, and I'm going to heavily comment everything so that everything's very understandable. But basically, you just throw this. What I'm using here is Visual Studio Code, and also free. I use 100% free. And all the data that I'm going to be downloading is going to be coming from Yahoo Finance. Again, 100% free. You can download 100% data, whatever you want. Okay, so what we have here are just all the libraries we're going to install, and they are for working with the data in multiple different ways. And did you do this thing when you worked as a stockbroker? Yes, I worked as a broker. I'm not going to say the firm. Trading. Yeah, I worked as a broker at a trading firm. Like, you know their name. Big, giant, huge trading firm. And mainly what I did there, since you're asking, I went there because I wanted to become an analyst. And whenever I don't know if it's changed, but back then you had to pass 3 different tests, and I passed the first 2 tests. But then at that point, I was just not very interested in being a stockbroker anymore. But yeah, I did all this stuff. And how I mainly learned all this stuff is that a senior broker, an older gentleman who really knew the stock market, he found out I was a programmer. And very early on, he said to me, I will teach you what is in my brain if you can take what's in my brain and put it in that computer. So that he wouldn't have to think as much. He could just type in the computer. And basically what I'm doing here is I'm showing you all the things over all of my videos, my Python for Finance videos, all that stuff. I'm showing you all the things so that you understand how trading really works. Trading doesn't work based off of somebody watching somebody on TV or somebody going on the internet and going, oh, this is a hot stock pick. That's how you get destroyed in the stock market. Wrecked. What I'm focusing on is I'm doing technical analysis right now, but what I talked about previously was how to create not risk-free, but how to create portfolios that would provide the highest rate of return at the lowest amount of risk. And I also talked about how you can dial in your preferred risk amount. When I say risk, I mean how much you could potentially lose in the short term or whatever. So what we're trying to do is minimize risk and maximize return. And this is statistically done. There was a man named Markowitz. He won a Nobel Prize for it. And it's what we do is we create what are called efficient portfolios. And they are portfolios that have a expected rate of return and a expected risk level. Now, of course, as you lower your risk level, you are going to also lower your return. So what you want to do is say, okay, I'm willing to lose 10% of my portfolio. I'm comfortable with that if I have the potential to get a 25 or 30 or whatever % return on average. And you can dial that in. Markowitz figured out how to do that. And he won a Nobel Prize, so he's not like a kook. He's not like some, rando on CNBC. He's an established, very intelligent human being. So that's mainly what I did whenever I worked at. I keep having to bite my tongue so I don't say the brokerage house. But yeah, that's mainly what I did was I created efficient portfolios. And if you, like I said, this is not investment advice, but if you want to know how well I did, in my time as a broker, I averaged rate of return of 32% for my clients. So, and that was me being very conservative. And how I did it was creating efficient portfolios. So, this is technical analysis, however, but it's extremely important also. So what I covered last time was how to get stock data frames from CSV files. We also covered how to get a specific column of data from CSV files. Again, this is on Twitch right now. You can watch that if you want to watch that before you watch this. So feel free to leave and my whole entire lobby will go away. But either way, I'm covering important stuff this time as well. How to save CSV files. When I say CSV, I'm talking about comma-separated values, which is how we're going to download historical stock data and be able to analyze it all. Okay, then we went and downloaded all the stock data. We deleted any empty files that didn't even have anything that we were interested in. We then analyzed if the different FANG stocks were worth investing in by downloading all real-time data. And then we went and got all of our closing prices. We plotted out. This is just simply the price changes for all the different FANG stocks over 5 years. Yeah, I think it was 5 years' time. And you can see all of those. But then we talked about how this chart's actually worthless because what we're really interested in is return. We're not interested in price because that doesn't really mean anything. We're looking for rate of return. So what we did was we calculated daily returns, cumulative rate of returns, and then we went and merged all those different stocks into another data frame, which is basically just a fancy spreadsheet. You can see this is a data frame right here. It just has a date, it has our 5 stocks that we're analyzing, and then what this shows is our cumulative rate of return on those securities. And what I did was I said, okay, let's say we invested $1 into all of the FANG stocks 5 years ago, and what would they be worth today, that $1? And we see here that, wow, this is why this chart's worthless. This is the type of charts people look at and think they know what they're talking about. But basically, this is a price chart. Well, this says that Amazon did better than anybody else. That's what that says right there. And then Google. And then this is Netflix. All right, so you look at this price chart and you go, well, I'm going to buy Amazon. But then what you do is you come down here and you look at cumulative rate of return, which actually is return, which was what makes sense. And if we go down to our data frame, we actually find out that Apple had a better cumulative rate of return than all the other stocks. See, it's why it's very easy to get misled by different securities. So then we come in here and we say, okay, let's invest $1 5 years ago. Which stock performed the best? And you can clearly see here, based off of cumulative rate of returns, that Apple outperformed, then Netflix, and then Amazon. But it just starts there. This doesn't even mean anything. I mean, it does. It shows you that Apple is a better performer than all the other FANG stocks, even though if you look at certain charts, it doesn't look like that. So then what we want to do is we also want to, what's going on? How am I doing? I'm doing pretty cool. How are you doing? I'm glad actually some people showed up, so thank you for coming over. How is price different rate of return? Well, price is just what the stock is worth. That's all. So, so for example, I'll use Tesla as an example. All right, this is both the best investment I ever made and the worst investment I ever made, all wrapped up into one fancy nice stock. Tesla. I bought it at $200 a share. Okay, and then I was like, I'm a very risk averse investor. I sold it at 1,000, so I thought that's a great rate of return. I'm not going to do better than that based off of what I was looking at. So I sold it. What actually went up to 3,000. What's Tesla trading at right now? What happened? Those are just prices. That's just here. Let me see. Tesla. What is Tesla? I try not to look at Tesla's stock price because it makes me upset. Okay, it's trading at $996. Well, that makes it sound like I'm a genius. The only thing is they had a 3-for-1 stock split, and Tesla is actually worth $3,000 based off of what I originally purchased it at. Make sense? It was a stock split. So the price is irrelevant. The price can be whatever. Because a company could do a stock split and the value would go down, but whenever you do a stock split, what happens is the price of individual shares goes down, but the total number of accumulated shares increases. So what Tesla did was they said, okay, we're going to offer 300% more securities to be able to be sold, but what that did was that cut in half the value of Tesla stock by 33%. Get it? I hope that makes sense. Tell me if that doesn't make sense. Okay, awesome. All right, so you get it. Okay, so price is irrelevant. We're only interested in rates of return. So then I showed you how to create a price chart and volume. I mainly did that just to show you how to do that. And now we are where we are. So basically what we did was in the first video, I showed you how to download all those different stocks and how to output them and how to add additional data to the information that you saw on the screen. All right, so what are we going to do now? Well, we are going to add Bollinger Bands to our data. And I'm doing this on its own, like with individual securities sometimes with functions. Of course, it makes more sense to always do it with functions because once you create the function, then what you can just simply do is go in and say, okay, I want this data on Microsoft, and you just, and it's done. If you go and do this for individual securities, you're going to have to go and retype everything. Complete waste of time. But in the learning process, I think it's sometimes important to do it on an individual stock basis and then convert that code you wrote into a working function. You just want to test to make sure everything works. Okay, so we get past a data frame to this. And what I want to do is I want to go and calculate my middle band. What I mean by middle band is a smoothed out moving average, which is calculated by getting the mean of the price of the security, and that's going to float and smooth out the rough edges of our price. So that's what we're going to do very first thing. So we'll go data frame, and we want to get our closing price. Now understand, closing price is not necessarily the closing price. This is the price depending upon the period. So if I grab stock data, let's say once per day, well, that's going to be the closing price. But let's say I grab that stock data every hour. Well, now the closing price is going to be the closing price at every single hour. Sometimes that gets confusing, and I'm just, like I said, if anything I say doesn't make 100% sense, so that's what I mean. I'm getting my closing price for that, but in this situation, I am working with days. Just wanted to clear that up so that you 100% understand what I'm saying. So this is just simply a mean average of the prices over a 20-day period. That's all we just calculated. So now we're going to go and get another data frame, or we're going to create another column for our data frame. So I'm going to go upper band like this and data frame. And to do this, what we're going to do is we're going to have our middle band or our moving average, a smoothed out version of our stock price data. And then we're going to add standard deviation to it. I'm going to do 1.96, which is kind of common. You can just do 2. It doesn't matter. Well, I mean, it does, but it affects your data. But, you know, if you can remember 2 better than 1.96, then just use 2. Okay. So then go and get whatever the closing price is, and I will do rolling, and we're working with a 20-day average, so this is rolling 20, and I'm going to get standard deviation of that. I'm going to do the same thing, and it'll make total sense whenever I output this. Oh, it doesn't matter. It doesn't matter. You could do opening or closing prices with Bollinger Bands. It doesn't matter at all. All you're getting is, you know, your data. If you start at the beginning of the day versus, it'll all smooth out and basically be exactly the same. All right, so I want to do also a lower band. This will make a lot more sense as soon as I plot it, I think, also. All right, cool. Definitely feel free to ask me questions because I want this to be understandable. I started this whole entire making these videos because I watched everybody lose countless amounts of money during the whole meme stock thing. And I was just like, if I can do anything to help people learn how to invest, I'm going to do it. Now, of course, I don't understand your personal situation, so you should most definitely arm yourself with an education, but then go and talk to somebody that actually knows you. That's why this isn't investment advice. I'm not going to give you stock picks. I'm going to teach you the basics because guess what? Most stockbrokers don't know this stuff. Most stockbrokers have no idea what I'm doing. Because I went to become an analyst, and most stockbrokers go to become stockbrokers to get rich. All right, so let's, here's all of our different meme stocks, or not meme stocks, FANG stocks. Throw those inside of there. And what else do we want to do? So we want to analyze these. So I'm going to say for X in, and it is stock data frames. And I'm going to cycle through every single one of them and then add the Bollinger Bands to all of them. So all in one move here. So add Bollinger Bands. And then I'm just going to pass in each of the individual securities. And boom, like that. And then I can go in here and verify that, let's say I want Facebook's data. And you can see over here that, yes, indeed. Whoops, you can't see because I have that covered. Let's go and get rid of this. I have 2 monitors, and I'm trying to be like, okay. There you can see we have our calculations for our middle band and our upper band and our lower band for Facebook. All right, but when I plot this, it's going to totally make 100% more sense. So let's go in and let's plot it. So plot with Bollinger Bands. So I'm going to create a function again, and I'm going to call this plot with Bollinger Bands. And dun, 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 ticker. Yeah, most brokers have no idea what they're doing here. Isn't the only safe way to trade stocks is to trade boring stocks? Growth stocks that make huge returns are also risky and highly manipulated. The best way to invest is to invest in all of the above. You want a portfolio that has, okay, I'll give you, here's an analogy. I talk about things like efficient portfolio. What is that? Well, what you want to do is you want to create a portfolio that whenever you want every single one of your stocks to be good. But what you want is you want stocks that when some of them go up, other ones tend to go down. And I'll give you an analogy here. Okay, so let's say you have Hershey stock. You have a candy company, all right? Now, a candy company, what would make a candy company go down in value? Well, if the price of sugar went way up. So that means that a candy company, whenever its stock is going, maybe I should do it this way. When a candy company, its stock's going like this, well, the sugar company, very well historically, may be doing this. So you want to get the best sugar company that you can in the world. Again, this is just an example, so that you smooth them out. So you want two powerhouse companies that are both on average over a year-long period are in the upwards trajectory, but you want to smooth out your risk by buying both of them. So you might be giving up, maybe the candy company is a high flyer and it's going to make a ton of money, but you want to buy that also good. It's not about buying a bad stock that lowers that, but you want to buy two solid companies that inversely go up and down. So, make sense? Tell me if that doesn't make sense. I can give you other examples, but basically that's what it is. You want to buy solid companies in multiple different, they call them stock sectors. So you could have things like financials, technology, like you want to buy boring stuff like railroads, and you also want to buy high flyers like your tech companies, like your Facebooks and Netflixes and Apples and all those. So you want a mixture of both boring companies like McCormick and, I'm not recommending any of these. I'm just throwing them out. Boring companies and high flyers, and also bonds. You want to have a mixture of all of them, and if you do that, then you'll be able to maximize your return versus the S&P. Now, the reason why the S&P is convenient, and I'm not saying the S&P is bad. Problem with growth stocks is that if they tank, you can sell them because everyone's going. Yeah, well, I'm not recommending buying meme stocks. That is speculative gambling trading. That's not investing. You don't really buy a meme stock like that. Now, there's risky securities that are more on the edge of investing because of I'm not recommending meme stocks. Let's make that clear. I made this tutorial mainly because I was anti-meme stocks. But yeah, you want to buy a mixture of securities. But there are things like sometimes people make risky investments, and they're normally based on things like changing in government regulations, changing government laws, things like that. Those are more like investments. Meme stocks are basically investing because a whole bunch of other people say we can pull our resources and make the stock price go up. That's kind of the difference. I hope, yeah, that makes sense. Okay, so let's go here. So let's go and create our Bollinger Bands and plot them. So what I'm going to do is I'm going to use all my fancy functions that I created in the last video. And I have everything stored in a constant that I call path. Here, I'll show it to you. This is the only time I'm going to show you this. Just so you know, I just got a new mouse because my other mouse broke. And I'm trying to get used to it. My old mouse, I used to be able to go, oh, you know what? Let's go and grab this. There we are. Okay. So where is it? My old mouse, I used to be able to spin it. See, this is just the directory where I have all my stocks stored. So that's what I'm going to use as path. And I always recommend to use constants anytime you can. Makes it a lot easier. And anybody that programs knows that. Okay, so let's just come back down here. So that's what path is referring to. That's where I have all my stock data saved. So what I'm going to do is I am going to go and create all of this. So I got that, and I want to have my path, and then I want to have my ticker that's passed inside of it. That's just the stock that I'm going to be downloading data for. Data frame and get stock data frame from CSV is what I've called that. And I just pass the ticker in and it provides me with that data frame. I then want to call my other function I created called add Bollinger Bands, and it's going to automatically add the Bollinger Bands to my data frame. Then I'm going to go and plot all of this. So I'm going to say this is figure, go and figure. And that just creates something on the screen for me to throw my traces on, my plots. I want to create a candlestick plot, which is going to show all in one chart. It's going to show the price. It's going to show if the stock is up. It's going to show the opening price, the closing price, everything, the high and the low. That's why candlesticks are awesome. And I'll show you that whenever I do this, whenever I plot it. So, and to create a candlestick, you just go and candlestick like that. And then you have to provide all that data. You have to provide things like the date and all of that. So you go data frame and index. Index is where the date is for that information. You want to also get your opening price. That's data frame and opening price. And you also want to be able to get your daily high, which again is going to be whatever your data frame is, and the high. Okay. And you can see all this, right? Yeah, good. Because I have totally different information here. Okay, so we got our high, and we're also going to, of course, get our low price for the day, and low, and also the close, which is going to be data frame, and our closing price. And also, I'd like to go and give this a name, which is going to be candlestick. Candlestick. All right, so I got all that stuff. All right, so we got all that set up, and now what I want to do is plot my moving averages and my Bollinger Bands and all that stuff. So I'm going to go and create an upper line, and you do that by saying go dot scatter like this, and x is equal to data frame dot index like this, and again y is going to be equal to our data frame open value. Oh no, that's not gonna. It's gonna be upper band is what I called it, right? Upper band, yeah, upper band. So we'll throw that there, and upper band, and then after that, I can go and draw. This is very important. How you color everything, because it's going to make it either easy to understand your charts or hard to understand your charts. So what I want to do is I'm going to define a line here, and I'm going to say dictionary. You put everything inside of a dictionary, and then you just define all your individual parts. So I'm going to say color is going to be equal to, and we'll do RGBA, and then I will say that I want this to be a red color, and there's like that. And every time I do this, it always ends up messing up. So I want this, there's where the quote's going to be. So I want this to be a red line bar or line chart, and 0, and I'm also going to define that I want the opacity to be 0.75, 0.75, just so that it doesn't conflict too much with our candlestick chart that we have inside of here. All right. So got all that set, and also let's go and define the width, and let's say that we just want our width to be 1, and then I'm going to give this a name, and the name is going to be upper band. Upper band like that, and I think I lost a parenthesis somewhere. Yes, I did. So I put it in. All right, so that's our upper band, and you'll see here in a second exactly what that looks like whenever it plots out everything. And then I'll show you how candlestick charts, what they look like, and how to understand them. Okay. Very briefly, because they're very easy to understand. So we'll just change this to middle bands, and what color do I want that to be? Let's say I want it to be blue. I think blue sounds like a good color for it. So that, and 250, like that. and this will be called the middle band, like that. And do I want it to be 1? I think so it doesn't conflict too much with my candlestick, I'm going to make that 0.7, and then I'm going to have a lower line also. And boom, like that. And we will call this lower line, like that. And this is going to be lower band. Isn't that what I called it? Yep, lower band. So let's go and throw lower in there. Lower band. Now what do I want to do with this? Well, let's make this G, green. So get rid of that. Oops, kick that there. And we will change this to 250, like that. And I want to make this 1, just like I did before. This is going to be the lower band. And I think everything else there, I want it to be exactly the same. All right, so that goes and gets all of that information for our line plots. And then you just go figure, and you say add trace, and you throw in all of the different stuff that you want plotted. So we're going to do our candle. Let's go and copy this. That's what I called it, candle. Oh, I called it candlestick. Let's call it candle. Let's be a little bit shorter there. All right, so we got this. Grab it, copy it, paste it. And like I said, if anything doesn't make sense, feel free to ask me. Keeps everything interesting here. So upper line and the, what is that? I called it midline, like that. And also we have our lower line. Lower line. All right, good stuff. So we got all of that information, and now what we want to do before we plot everything is we want to just go and update what is going to be shown on our plot. So I'm just going to go and let's say I want to go update, and it is x-axis, and I just want to put on the x-axis that this indeed is the price, is the data that I'm showing right there. And sometimes people like to go and put like USD so that they know, dollars, but I'm just going to leave that off of there. Whoops, I typed in price. I meant to type in date. Date, like that. Next thing's going to be price. Got ahead of myself. All right, another thing I'd like to have is a range slider so that I can zoom in on data and move out on data so I can really analyze it. So I'm going to go and call range slider and visible, and I'm going to set that for true. And there it is. Okay. Now I'm going to do something similar for the y-axis, and I'm going to go update and y-axis. And if you're wondering, yes, this is the type of stuff that like stock analysts do. The algorithms and all the functions and stuff are already created for them, but then they go and search the market looking for specific things, and then you start looking for different stock patterns as well, which I'll get into if people have interest in that. All right, I think that's all I'm going to do for the y-axis, and then I'm going to just change the overall size of my update layout. I'm going to change the size of the plot so that it looks nice on the screen, and I am going to define the title to be equal to the ticker symbol that they passed in, and then on top of that, I'm going to say Bollinger Bands, like that, so that they know what, or or whoever knows what is actually on the chart. Whoops, didn't mean to do that. So let's go back here, throw that there, jump down to the next line. Now I want to define the size of my plot. And this works good for my screen, and that's why I'm choosing it, obviously. Let's go and define our width. Our width is going to be larger. Let's try 1800. And I want to show the legend so that, that's legend, show legend. Yeah, it's like lowercase. I want to show the legend so that you can actually understand what everything is. You just see there, and then I go figure and show, run it, and boom, you got a plot as long as I didn't make an error. Well, I actually have to go and call it first. So I'm going to go plot with Bollinger Bands, and let's say that I want to look up, anybody want me to look up something specific? I'll just look up AMD, because that's always what I do. So it's getting all the data for AMD, and you can see there's the stock price. All right, and here are this provides the ability to search and go inside of there, and you're going to be able to see with the Bollinger Bands both the resistance line, which is up here, the support line that's down here. But understand there's multiple different types of resistance and support lines. And this is your average, moving average. You can see how they are going to smooth out the massive fluctuations in stock prices. And this is just the standard deviation. And you can see that AMD went and hit a resistance line, fell down and hit a support line, and is now bouncing back. All right, and that is what a stable company does all of the time. And let's see if I can zoom in on some. I'm looking for a candlestick that actually is big enough for me to look at. Let's look at it. Basically, the way the candlesticks work is you're going to have your high price, your low price. I can't really zoom in there enough. But basically, if it's green, that means it had an up day. Red, it means it had a down day. The low is going to be the bottom of the candlestick, and then you're going to have the top be that high price. All right, so that's basically that's what they're called wicks. Other people call them other things. I can't. Shadows. They're also called shadows, and that's what the tops and bottom lines are referencing. Okay, so you have your opening price, your closing price with the actual squares themselves. And then you have the highs and the lows are the wicks. So that's the difference between, you know, all that data. All right. Hopefully that makes sense. So let's go. Now we got all that, and we were able to plot Bollinger Bands. So now I want to talk more about support and resistance. Now we basically, I talked about it before. What we're going to do this time is we're going to really focus in on support, because support is extremely important. And we'll get more into things called death crosses and golden crosses. Those are normally historical buy or sell signals that have been proven over the test of time. So give me 1 second. I want to go and check one thing, and I'll be back in 1 second. I'm having a slight technical issue. I'll be back literally in 10 seconds. All right, see, I'm back. I have to get a drink. Last time I did this, I totally blew my voice out. So I have to get a drink every once in a while. Otherwise, I'll blow my voice out because I talk too fast and I don't drink enough water. All right, so let's move on. So I'm going to show you how important support lines are, as well as resistance lines. But I'm going to focus on support lines right now, because historically they have worked. So, all right. So what do I want to do here first? Well, I'm going to go and download some S&P data, and I'm also going to go and calculate the moving averages to create our support lines. So what do we want to do here? I'm going to say, well, let's put this up here, and I just need the ticker for the S&P. So I'll say save to CSV from Yahoo. So I'm going to go and download all that data. I'm going to say that I want it to be saved into the directory that I defined. And then I'm also going to go and get specifically the ticker for the S&P 500, which is GSPC. All right, got that. Then I'm going to go and convert all that data into a data frame, which is basically just a file that's kind of like a spreadsheet. And we will be able to work with it. And I'm going to get the stock data frame from the CSV, which is what I just downloaded from. And you might have trouble if you're on a Mac, because I think the Macs don't like these caret symbols. So you're going to have to get rid of that. So just get rid of it. And if I do this, I can go GSPC data frame, and boom, and it's downloading all my stock data frame information for the last 5 years for the S&P 500, and it dumped it all over the screen. Okay, so what I want to do now is I want to calculate moving averages, and there's multiple different types of moving averages. Basically, I can go over this a little bit. but like I said previously, they smooth out massive fluctuations in price. That's why we use moving averages. And you get them, like I showed before, by getting the average or the mean of the price changes over a certain period of time. Now you have multiple different types of moving averages. You have simple moving averages, which is just a simple mean. That's all it is. It's an average of the price changes. Then you have an exponential moving average, and it's a weighted moving average that puts more emphasis on data the more recent it is. It's the only difference. So EMA is going to put weight, or is going to put, say, this new recent data is more important. And the SMA is just going to say everything's the same. Who cares? All right, that's the difference. So I'm going to show you how to calculate both of them. So let's get the simple moving average, and I'm just going to go GSPC data frame, and I'm going to get moving average, and I'm going to do on a 50 period time. So GSPC and data frame, and I'm going to get the closing price data dot rolling. And again, this is a 50 period chart, and like I said, it's just a simple mean calculation. That's all it is. It's an average. So let's drive this, drop that. But you're going to see how important this stuff is here in a minute, because it literally just predicts where the stock market's going to go. Mainly what it does is the stock market goes up and down, sometimes inappropriately or incorrectly, based off of things that have nothing to do with the stock market. So things like pandemics and elections and wars, things like that. That's what we want to take advantage of. We want to have stable heads and say this so will pass. So there we are. We have our 100 period and our other one. So let's go GSPC. And I'm also going to save the exponential moving average also. So this, I'm going to call it EMA, and 20 is equal to GSPC data frame, and again we're working with our closing prices. And to do the exponential moving average, you're going to go EWM, and we're still working with 20 period, and you just define it in a different way. You say span and give span a value. And I'm also going to say that I'm going to set adjust to false. And well, you decide based off of, both are good and both provide good information. You just want, you pick either SMA, simple moving average, or exponential moving average based off of if you want it to get less smooth as time goes on. So if you want to say what recently happened is more important than what happened 5 years ago. So you can do either one. I'm actually going to show you the simple moving average just to show you how accurate it is. So it's more than enough. All right. So I guess that's it. That's all I need to do there. So it's just going to depend on your situation. I tend to like the exponential moving average, but I'll show you the simple moving average also, and you're going to see that they don't differ that much over long-term periods. So we're just going to do another 50 period, and oh yeah, I have to go and calculate the mean for this, and also the mean for that. All right, and let's just go and copy this also, and throw that down there. And we're going to change this into a 100, and that means this needs to be 100, and all the rest is the same. And if we want to go and actually see that this works, we can go GSPC data frame like that, and now we can see that we have, you can see there, you can see that we have all of those different moving averages all calculated outwards. And you can also see that with the exponential moving average that you get immediate results. With a simple moving average, if you say you want a 20 period moving average, well, you're not going to have any data for the first 20 periods. What it does in the situation with an exponential moving average is it recursively, it sort of like guesses past data. That's how you get immediate results here. So it's called recursive data. All right, but you're not really that interested in data whenever it's first created. All right, so we got that. So what we want to do now is we want to plot these moving averages so that you can see the S&P's performance and how the support lines have actually historically worked. They have said, basically what the support line it says is, hey, people are overreacting right now, and if you're a smart investor, you should buy. That's what the support line does, all right? But it's hard to do that because everybody around you is running around like the world's coming to an end, and we all know what that's like. So we'll have the great pleasure of knowing what that is like. All right, so let's bring this back. Where did I have? I'm not going to type in Candlestick again. So let's go and get the candle, and let's get this. And because I don't want to type it again, and I'm missing my old mouse a little bit here. All right, so let's go and do candle. And what we're going to do with our candlestick plot is it's basically just going to be GSPC. So let's just type in GSPC. That's what I called it, I believe. GSPC data frame like that. And then we're just going to replace all this. So I'm going to say copy and copy. Paste all these in here so that we're using the right data. And then I will also show you how to create the functions for this. But this is a situation where I just wanted you to really understand something specific, which is the S&P 500, which is what we're using right now. All right, let's do that. And this is going to be different, though. This is going to be EMA 50 line. So EMA 50 line. And here I'm going to be using the exponential moving averages. I actually prefer those. All right, so let's paste that in there because I personally think the most recent data is more valuable than something that happened 5 years ago. And I think most people would agree. Okay, so GSPC, and then this is going to be, I believe, I call this EMA 50. And what color do I want this to be? Let's just let it be that. I think that's fine, which is red. And I'm going to also call this EMA 50, just so you can see what it is. And then, do I want it to be a width of 1? I think I do. I'm going to let that be a line width of 1. And normally I keep everything line width of 1. Of course, it depends upon the user, what you want to do. All right, like that. And the only time I ever make it less than 1 is whenever I want to, it crosses over other data, and I want it to be less in your face. So EMA 100. All right, so we got both of those set up. And then I just simply have to add the trace. So we'll go figure, add, trace, and I'm going to throw in my candlestick. And then I'm going to also go and throw in what is called the EMA 50, 50-day period moving average, exponential moving average over a 50-day period, whatever you want to call it. This is what we call our first support line, and then we have a second support line, and if he crosses through both of them, that is almost historically, as you're going to see here in a minute, a amazing opportunity to purchase, as long as the security you're investing in is a rather secure security, like a well-crafted portfolio or a S&P 500 or a very large index. Okay, boom, and we run it, and there you can see. So what we went and did was we created our, let's zoom in and look at the data. All right, so I'm not seeing both of those. What's going on here? I might have typed something in wrong. So I have to stop and get a drink. Last time I did this, I lost my voice. There's the air. Okay. All right. Sorry about that, but I have to drink. So we can see here is our support line. Maybe I should increase the size of this. I'm going to go and copy that so that you can see this way better. So where do I have? There's my update layout. So I'm going to copy this, bring it down here, and paste it in. So where is it? There it is. So let's paste this here like that. And this isn't Bollinger Bands, though. This is S&P. Get rid of that. Throw that there. And I'll just call this S&P 5 years. And let's try this. Let's try running that instead. Oh, I have figure show 2 times. Get rid of that. Whoops. All right, get rid of that and run it. Okay, so this is much easier to see. Okay, so this is the S&P 500 and what it did over the past 5 years. So if we zoom in here, these are our support lines, and we can see situations in which we crashed through our support. We can see this right here with the year with 2020. You can see precisely when everybody went crazy. So let's go right here, and we can see that the market broke through our first support line, which was red, and then our second support line, which is the orange line, I think, or is that green? I don't know, I'm colorblind. I think it's green. And let's bring it in here, and you can see all of that data. So there we broke through our support. What did we do? Of course, we came back. You may think, well, that's a major situation, and does it ever break through its support line at any other times? Of course. You can see up here, for less important information or events, it most definitely does. So let's come up here, and you can see another, for instance, of when we broke through support lines. Well, what was going on in the world, or at least in the United States at this point in time? Well, this was the election between Biden and Trump. So that's another situation where we broke through those support lines. And but we did. What happens? We came back. That's always what happens. It always does. The world continues. It continues to go on. And these are what we call our major buying opportunities. So extremely good. And I'm also going to talk about golden crosses and death crosses, and also what they tell us. So anytime you hit a support line with a security, as long as it is a secure investment, you can expect that to be a good buying opportunity. And let's see where the market is right now. Right here. What happened? We approached that second support line, bounced right back. We again approached it here. What happened? Market went from 45.16 to 46.02 in one day, and then the very next day continued to go up. So if you're smart enough to invest like this, when everybody else is running for the exits, you pile in. It's a good way to invest. It's definitely a lot better than randomly taking advice from people on the internet. Okay, like myself. Okay, so let's go and let's just go here. This is just the beginning of your education. Most people never get even this far, though. All right, so we'll just come in here and let's analyze Bitcoin, for example. So I can go BTs, because everybody always asks me about Bitcoin. So Bitcoin and data frame is going to be equal to, and I'm going to go download all the Bitcoin data. I'll show you a whole bunch of different cryptocurrencies. For some reason, people think cryptocurrencies are different types of securities. Also, what do you think of ETFs and index funds? An ETF and index funds are perfectly fine. There's nothing wrong with them. The problem is you're not buying the best stocks. You're buying all the stocks, okay? So if you buy every single stock in the world, is that going to bring down your overall risk? Yeah, because you own everything. But you also take on basic market risk. And you're also buying companies. There's a lot of companies in the indexes that are garbage companies. Do you really want to own garbage companies? So index funds work perfectly fine for a lot of people that don't want to think. It's okay. I mean, you got better things to do in your life than sit around looking at what good investments are. But it's so extremely easy to find the best companies in the best sectors. It's literally like a couple lines of code, and you can do it. If I was more prepared, I'd show you that, but I wasn't prepared for that question. Maybe after this video, in my Discord, I'll post that algorithm. I already covered how to go and find like the top 20 stocks in every single stock sector. Now, if you invest in the top 20 stocks in the best stock sectors, you're going to get diversification, but you're also only going to be buying good companies. Now, if you just buy an index, the downside of that is you're buying all the bad companies, all right? And a lot of those companies will go bankrupt and they'll be delisted and so forth. But are indexes bad? No, their indexes are absolutely fantastic, especially if you don't want to do this stuff. How many people even understand what I'm doing in the world? Not many. you six that I'm looking at right now. That's not true, but there's very few people that have the interest in doing this, and I understand. You got other things you want to do in your life. I just personally think that investing is kind of some knowledge that might serve you well in life. Okay, so what I'm going to do is I'm going to download Bitcoin, I'm going to get 3 days worth of data, and I want every 15 minutes of that data. All right. And you want to see what that looks like and see how long it takes to download Bitcoin data. Whoops, what was wrong? What did I do wrong? BTC, DF. Did I type in something wrong? Tickers, BTC. Oh, I see what I did. I put an underscore instead of a dash. Looks like this. Boom. All right, so there's your Bitcoin prices over a 3-day period with every 15 minutes grabbing that price data. See, this is close right here in this situation. It's obviously not the close of the day. It's the closing price after that 15 minutes. All right, Bitcoin's doing very well over the last 3 days. All right, so what do we want to do now? Well, let's just jump in here. I want to create my short-term moving averages. So I'm going to say BTC-DF, and I will just call this MA5 just to be nice and simple. And BTC, data frame, and close, and do a rolling average, and I'll do 5, and that's 5 periods, like 5 15-minute increments. So we'll do this, and I'm gonna go and get this copy like that, and like that, and MA20 like this. Just want to make sure your data is up to date, and it's also taken from the same time periods. Otherwise, you might see really weird things. Okay, so I got those 2 moving averages. I've covered moving averages. You know what they are. So let's go and plot it. So I'm going to say, I'm probably just going to copy a lot of this stuff. Gotta get a drink again. Don't listen to Jim Cramer. Jim Cramer don't know anything. Here, let me see if I can show you something. This, I'm going to show you who Jim Cramer thinks. At one point in time, he came out publicly. Dykstra. You want to see? This is some information about Jim Cramer. Okay. Jim Cramer thought that Lenny Dykstra was the greatest investment mind. Let's see if I can pull it up. Lenny Dykstra. Let's see if I can pull it up. Cramer. Investment. I think he actually called him the greatest investment mind he'd ever met. Of course, it all came back. So let's Lenny Dykstra. I don't know. Just type in here. I'll tell you what to look for. Here it is. You want to read a story that'll tell you a lot about Jim Cramer. Here is the story for you. Let's go. Boom. This man is a maniac. Okay, there it is. Lenny Dykstra, Jim Cramer, investment mind. Yeah, he called him the greatest investment mind he'd ever met. The man was insane. He ended up going to prison. Yeah, so I wouldn't advise. If there's anything I could advise, it is to not listen to Jim Cramer. Okay, so and he's infinitely wealthier than me, but whatever. I can't believe me. I've had many opportunities in my life to become way wealthier than I am. I just chose not to do those things. All right, so Candlestick. Yeah, Lenny Dykstra was a lunatic. Is a lunatic. Well, you know, he's a lunatic. Maybe I shouldn't say that about somebody who's a lunatic. So I'm going to go and copy this information so that I don't have to type it out again. So I'm going to go Candle, and it's a fascinating story. There's a guy on YouTube that made a really awesome video about Lenny Dykstra also. I don't have it here right now. Okay, so Bitcoin data frame like this, and throw this inside of here. But yeah, he was a baseball player, and basically what he was doing to simplify things is he was trying to convince people that he had these great rates of return, and how he did it was he bought a whole bunch of different stocks, and if a stock did bad, well, he just didn't include it as in his return, and he had so many risky investments that he the risky ones that paid off ended up doing really well. So if you just lie and don't talk about your losses, it makes you look like you're a genius. So all right, so we got, let's just do MA 5 line. Let's call this, that's what I did, right? MA, yeah, there it is, MA 5. And let's do, did I save the Bitcoin part? Let's see if I did. Yep, I did. All right, so we'll throw those lines in there, and then I'll create functions for all this stuff. So I'm going to go MA, and this is going to be MA5, like that. And what do I want to do for the colors? Well, I like to do kind of fancy stuff sometimes, so let's make this orange. So I'm going to say 255, 165. I think it works better. And what this is going to do is, you know, show the moving averages. And also what it's going to do is it's going to show you what's called the death cross and the golden cross. And you'll understand that as soon as I plot it out and it makes sense. This is going to be MA5, A5. And do I want them to be 1? Yeah, I think I do. So I'm going to have this be here, copy, and paste. Whoops, that's fine. Just drag this over here, get rid of that. This is going to be MA20 line, and let's say MA20. That's what I called it, right? Yeah, MA20. And that's a problem whenever I make the letters real big so that you can actually see them, but then it makes it harder for me to tell what I'm doing. And let's make this green. And this is just RGB, of course. So we'll make it green like that, and we'll keep the opacity at 75%, and we'll change this into MA20, exactly like that. And then like this, and then I just need to go figure add trace, and throw in the candlestick plot, and then I'm going to throw in the other two moving average plots, and we will be able to see the death crosses and all that stuff. So we'll go MA5 line, A5, whoops, MA5 line, and this is the M20 line. So MA20 and line, and then a go figure also. So we'll do go figure, or figure show, figure and show, like that, and run it. And there you can see. And now I'm going to show you what is the difference between a death cross. Well, let's go and copy this also, so we can zoom in here a little bit better. So we grab this guy, and these are major buying and selling opportunities, death crosses and golden crosses. Paste it in there, right? This is Bitcoin though, right? Yeah, I think so. All right, so let's run it. Boom. All right, so here we are. And basically what happens here, I think you can see this well, right? Maybe I want to zoom in a little bit so that you can see it a little bit better. Or maybe I want to increase the width of these lines. So let's change this to 2 and 2, like that. Replot, boom. There, you can see it much better now. All right, so the way these work and what a death cross and a death cross is clearly bad, and a golden cross is clearly a good thing. All right, so here we got them. There they are. All right, so basically whenever the MA20, or the moving average over a 20 period time, or what you can easily see here as your blue line, whenever it crosses above the orange line, that is what we call a death cross. And whenever that occurs, that normally signals a major drop in value, as you can see right there. There's other situations in which they're much different. Now, anytime you have a orange bar, which is going to be your MA5, and it crosses above the blue, that is what we call a golden cross. And you can see right here how dramatically the price changed. So that is what these two moving averages are used for, and that is the definition of a death cross and a golden cross. So once again, when blue crosses above the orange, that is a death cross. That's a bad thing. Whenever the orange crosses above the blue, like we see right here, that is a good thing. And that is what is deemed to be a buying opportunity. All right? But this is over a 3-day period, and it's also extremely important to look at this data over longer term periods of time. So let's do the same thing with long-term Bitcoin. And I didn't just say buy Bitcoin, by the way. That's not what I said. I just said that's what that is. Okay, so let's go. And I'm not even implying that. that's just showing you what they are. All right, so let's do it over the long-term period of time, and you're going to see that things change dramatically. So we'll go, and they weren't very definite there. Basically, all this chart shows us is that Bitcoin is very volatile. And obviously, everybody watching this already knows that. Okay, so what we're going to do now is we're going to calculate long-term Bitcoin. And I just put an L there. That's the only thing I did. All right, so download and tickers is equal to, and I'm going to throw in Bitcoin USD. And the only reason I'm covering Bitcoin is because people ask me about it every single time I make one of these videos. So I'm going to say period, and let's do a longer term chart, Bitcoin, which is going to be 3 months. And let's say that I want to get closing data every day. That's how I do it, right, like that. And like this, and I could go BTCL and data frame like that, and no data font. Oh, I did the underscore with Bitcoin again. There we are. Okay, so we got our data for Bitcoin. And now what I want to do is calculate the moving averages. So let's just go and copy moving averages, which is right here. Grab that. And I'm going to create functions that are going to allow you to just dump the stuff in and look up stock data on anything, on everything, basically. All right, so we got this. Just change this to BTCL for long-term moving average. I have to get a drink. Because if I lose my voice, I'm going to be done. All right, so there we got our calculations for that. And we could also go BTCL, data frame like that, and you can see there are our moving averages also. Just give me 1 second, and I'll be back again in 15 seconds. All right, back again. Okay, so let's see here. What am I doing? Let's go and plot this. So short-term plot, and I'll do a long-term plot for this. So I'm going to say figure is equal to go dot figure, and again we're going to do candlestick, and then we're going to create a function for that. Why don't I just do it? Do you want me to show you how to do this, or should I just go and create the functions? I'm just going to create the functions. You get the point. All right. I'm just going to create the functions for this rather than wait to do that. So I'm going to create a short-term plot function. So let's just go define and get short MA and pass in the ticker. This is going to allow you to basically do these moving averages on every single stock like that. All right, and basically what we're going to do is we're just going to copy and paste every single thing we just did before. So we're going to grab this. So let's just copy that, throw that inside of here, and we're just going to change this into data frame so it's not confusing. And the ticker is going to be whatever the ticker is that they pass in, and it's going to work for every single type of security as long as a ticker exists for it. This is short term, so this is going to be a 3-day. And we defined that we want to use 15 minutes worth of data each time. I'm going to go and get this data right here, which are going to be our moving averages. The periods don't change. The only thing that changes is our period and our interval. So that doesn't change ever. So let's just come in here, and there we are. Get rid of that, and let's get rid of that. And like I said, feel free to ask me questions if I say something that doesn't make sense. All right, data frame, let's get rid of the Bitcoin part right there. And then these nice functions are going to make it extremely easy, so you never have to type code. You just go da-da-da-da, and it works. And then we'll go figure and go, whoops, I always do that, equal to, and go dot figure, like that. Okay, so now what do we want to do? Well, we're going to get our candlestick plots and all our other plots. So we can just copy that, very, very convenient. So our candlestick, let's just copy this whole thing. I think most of it's what we need. So let's just copy it, and we'll come down here, and we'll paste it inside of here. So there it is. And we just have to tab these over, and then change the type of data that we're working with to just data frame instead of what we did before. Okay, So we got go figure. This is all the same. Let's go and get rid of the Bitcoin part. Change this to data frame. Change this to data frame. All our work is done, by the way. We're just basically cleaning this up so that we can easily turn this into a function that we can just rattle off a couple keys rather than rattling off tons of keys to get all of this information out of here. All right, done. Candlestick. And there's that. Let's get rid of this also. And then the next one's going to be even easier because all we need to do is change the input date. And everything else is going to be exactly the same. So do I want this to be, yeah, I'm going to let this be orange. I like orange sometimes. So again, I'm colorblind, so my color choices might not be as good as your color choices. Everybody's different. All right, so and this is obviously not going to be Bitcoin. Let's change this to that. And do we even care? Well, yeah, I guess so. So it's going to be, let's just change it to ticker. And I don't know, data. There we are. All right, so there's all that. Throw that down there. I didn't get an error, so I think everything's good. And our long-term one, we're going to do that also. So we're going to be able to wrap these into two functions, output them, and everything is just going to pop out all this information for us. So we'll just change that with short. We're going to change this to long, MA. We're going to change this to 3 months worth of data. And we want information every 1 day is what we're looking for there. All of this stays the same. All that stays the same. That also stays the same. Yeah, the only thing that changes is our period. So let's do this. And now what we can do is quite easily type in a short command, and it's going to pop out all the information we could ever want. So let's say we want a long-term plot for Ethereum for the moving averages to see if it looks like a good investment. So we'd just go get long MA like that. And then just pop in our Ethereum stock ticker. And I did it right that time and run it. And there you can see is the Ethereum data. And we have our orange lines right here and how it is changing. So obviously, whenever orange is above blue, that is buy. And whenever we cross, like we do right here, that is a death cross. That means sell. Whenever we get here, buy. Whenever it goes here, death cross, sell. And it continues onwards. Okay. Yeah, you can see that is a long-term chart for Ethereum stock. All right, so that is a negative. So what we want to do here is we want to say get short MA like that. And again, we're going to pass in Ethereum again. If you want me to type in a specific stock or basically anything, just give me the ticker and I will do it. There we are. Here is Ethereum over the short period of time. And you can see that currently, again, this is short term. It doesn't have as much strength. It's much more dramatically more volatile. Currently in an upswing. And long term, if you want to do Litecoin, I don't know, whatever you would like to do. So let's go get and long MA and Litecoin. So Litecoin. Did I do that again? Dash USD like that. Run it. Boom, there it is, and not looking particularly good. And let's do another one. Get long MA, and Cardano is ADA, isn't it? ADA, I believe. USD, like that. I don't know. There's another one. Okay, so there is some different cryptocurrencies and what the charts are telling us about them currently, which is not very good. So just for your information. And I think that's pretty much everything I wanted to cover, unless you have any additional questions, which you can feel free to ask me. Tomorrow, I'm actually going to do a live stream. It's going to be really fun at 1 o'clock. I'm going to show you how to take this guy right here, full screen, there, this. And do you ever wonder how, like, to make, like, an arcade type of system where you have servos, if you don't know anything about electronics. Let's see, it's popping out. I have to pop it back into place. I could probably do that later. But basically what this does is it reacts to different impacts, and it allows you to go and move servo arms around and score and do all kinds of things with what is basically about $10 worth of components. So I'm going to do a video about that and show you how to program this little guy tomorrow at 1 o'clock if you're interested in learning about electronics and things like that. And I don't think I have anything else unless you guys have questions. Doesn't look like it. And of course, feel free to leave me any questions that come up afterwards. when I am done. Mainly I want everybody to ask me questions on my Discord channel because YouTube is getting rid of comments sometime next year. That's what I've been told. So that's the reason why I created my Discord. Thank you everybody for joining me today, and I'll see you next time.